Hi there, welcome to Kneppy's Invest. In today's Kneppy's analysis, I'm going to look at a company called Data. I have been following this company since about 2014, and back then I nearly took a position in this company, but there was one red flag that really prevented me from buying shares in Data. I'll talk about that red flag later in the video. Now, you could say that was a mistake because the share price of Data has really outperformed the market over the past 8 years since I first did research on this company. And congratulations to the management team of this company, particular the founder, David Dicker, who founded this company back in 1978. He's still in there. There is skin in the game, and he's done a fabulous job in growing this business over the past 11 years. In fact, ever since 1978. And recently, we have seen the share price of this company pull back. So I thought it'd be a good time to take a closer look at this company for a potential long-term buy. And I do consider this company to be a higher quality company. I wouldn't say it's the highest quality company, but definitely on the high quality side of companies within the ASX. So let's get stuck into the video talking about Data. Now, for full disclosure purposes, I'm not a shareholder of this company. In fact, I have never been a shareholder of Data. I came very close in 2014 or 15. I was almost hit that buy button, but there was one thing that held me back. And I'll talk about that one thing again later in the video. But at this point in time, I'm not a shareholder of this company, but with the share price pulling back, with the valuation pulling back as well, I have put this company onto my potential buy watch list. So I am following the fortunes of the company and the share price a little bit more closely. Now, I wouldn't say in terms of valuation, this is a screaming buy right now. That's just in terms of valuation. But if I do see the share price pull back significantly from here, this could turn into a buy for me. I've already discussed a little bit about the history of Data, founded in 1978 by David Dicker. We'll talk about him in the next slide, if I remember correctly. So around 45 years, this company has been in existence, and it has grown quite meaningfully since then. In fact, you could say, just by looking at the revenue has accelerated because this company took 22 years, or took the company 22 years to get from zero revenue to 100 million revenue. It took them 15 years to get from $100 million revenue to 1 billion, another 5 years to get from 1 billion to 2 billion, and then 2 years to get from $2 billion of revenue to $3 billion of revenue. Now, you'll notice this company has a lot of revenue, so they generate massive amounts of revenue. And one of my problems about Data is their business is on really low margins. Now, that does not necessarily mean this company is low quality. There are some quite high quality companies out there that do exist on very low margins. And probably the best example of that is Costco. And I definitely would consider Costco to be high quality business. But the majority of high quality companies do their business on high margins. And Data is one of those companies that I do consider high quality, but has very low margins. Now, I haven't really talked about what this company does. They're a distributor of IT hardware, software, and other technology solutions, primarily for the corporate and commercial market. I wouldn't call David Dicker, the co-founder of Data, a close, but I didn't find many interviews with this CEO of Data. And there's probably a really good reason behind that, because more than likely, because he is the co-founder, a director of this company, also the CEO, probably more than 95% of his time, his waking time, is spent leading this company. He wants to grow this company because he's been with Data after co-founding it for 45 years. And the very fact that he's the co-founder of this company, he's also the CEO, and he does have a financial interest in this company, is one really attractive thing about Data. In fact, there are some investors out there who only invest in founder-led companies like Data. Another attractive thing I did find when I went through the board of directors and the management team of Data is the stability within that management and board of directors. In fact, there was one manager or one of the board of directors who has been with this company since 1978. Now, one slight negative going down that road is sometimes you do need fresh blood into the management or the board of directors just to bring a new perspective, because you don't want to get stuck in your ways. So maybe you could say that's one slight negative, but I do like that stability within the management. I do like that stability within the board of directors. Now onto the quality of Dicker data, and this is a very important step in my investing process. I want to differentiate high quality companies from low quality companies because I treat those two groups of companies or type of companies quite differently than the other. So for instance, low quality companies I don't want to own for the long term. They're more trading stocks or trading companies. So you own them when times are good, and when times are bad, you don't own them all. A prime example of low quality companies is mining companies. And mining companies are always faced with cycles. So cyclical stocks are definitely low quality companies that you don't want to own for the long term. Now, when it comes to Dicker data, there are some arguments against calling this company a high quality company. One of those arguments is low margins. Another argument is potential lack of moat or competitive advantage. But there's definitely some arguments for calling Dicker data a high quality company. In particular, growth in revenue over the past 13 years since they've been a listed company. Now, I do have a spreadsheet, and whenever a company releases half-year, full-year results, I have a look at the company, and then I jot down some of their financial numbers, also jot down my thoughts on the company, and either some thoughts about the full-year or half-year results, and some questions I have in regards to that company. So these are my thoughts on Dicker data after they released their full-year results back in February. Margin pressure in financial year 22 led to a small decrease in profit. So because this company has or exists on really low margins, if there is some margin pressure, that's going to have a significant effect on profit, and we saw that in financial year 22. Is those margin pressures, are they company structural? So that would be a problem, or they're just macroeconomic. Are they just short-term issues the company is facing? And the question I had was, there was a substantial decrease in final dividend. And I'm going to talk about that later in the video. So at this point in time, when I did look at their full-year results, I was wondering why their final dividend was significantly lower than the previous year. But fortunately, that question was answered when I delved a little bit deeper into their results. Now to the financial year 22 results for Dicker data, and this company's financial year corresponds to the calendar year. So they released their full year results in February. They'll release the half year results in August. So as I'm recording this video, share price of Dicker data is about $8.32, which means the market cap of the company is $1.5 billion. So I already mentioned that this company has really low margins. You can see that just by comparing the revenue to the profit. Revenue of $3.1 billion and profit of $73 million. So it doesn't take much to see this company's profit really affected if there's any squeeze on margins. And we have seen a squeeze on margin in financial year 22, and profit did drop. So even though the revenue for this company increased significantly from last year to this year, profit actually fell. Not only did profit fall, this company was operating cash flow and free cash flow negative. That's not necessarily a bad sign or a red flag. Now, if this company was consistently operating cash flow and free cash flow negative on a yearly basis, that would be a negative or red flag. In fact, the main reason and the one reason I did not invest in this company back in 2015 was because the first 4 years they were a listed company on the ASX, they were operating cash flow and free cash flow negative. They became operating cash flow and free cash flow positive in 2016 or 17, and that seems to be the catalyst for a nice breakout in the share price of this company. So it seems like the market was really paying attention to the operating cash flow and the free cash flow of this company, and when they hit that inflection point of becoming positive in those two metrics, that's when the market took notice of this company, and that's when the share price really took off. Now, one of the reasons I don't necessarily consider a company being operating cash flow or free cash flow negative a bad sign or a red flag is because it doesn't really take into account changes in working capital. And changes in working capital can be important and can give you further insight to how a company is performing or how a company is planning for the future. So to get an insight about changes in working capital, you can sometimes just look at the presentation or maybe the media release, because sometimes they will have a slide in there talking about changes in working capital, or you can just go to one of the notes. And the note should be stated, or which note you have to look at should be stated within the statement of cash flows. So I've gone straight to that note, the relevant note within Decadata's financial statements, and that is note 30, reconciliation of profit after income tax to net cash. And within this reconciliation, you can see how the company went from a profit of 73 million to an operating cash flow that is significantly lower than that. Now, their operating cash flow, or their reported operating cash flow of $1.1 million is higher than the operating cash flow I reported in the previous slide. And the reason behind that is I take into account lease liabilities, simply because, in my opinion, if you rent out something, that is a part of the day-to-day business of a company. That's just my opinion. So I like to be a little more conservative when it comes to leases. So I usually detract or subtract the lease liabilities from the operating cash flow the company has reported. That's why I have a negative operating cash flow for Decadata, yet Decadata reported a positive operating cash flow. But still, there's a significant difference between the profit of 73 million and the operating cash flow 1.1 million. And the most likely reason behind that discrepancy is going to be changes in working capital, which is changes in inventories, changes in receivables. And if we see a significant increase in both of those, that is a cash outflow. And that's definitely what we have seen with Decadata. In fact, there's been an increase in inventories by almost 40 million and an increase in receivables by 124 million. Add those together, you get $160 million cash outflow. But there's also been an increase in payables, and an increase in payables is a cash inflow. That was 86.7 million. So if you add all those three together, you get about $74 million. So if you add $74 million to the operating cash flow, you get close to that profit. So again, even though the company was operating cash flow negative, free cash flow negative, I think that can be a mistake if you just focus on that and not look at the reasons why there's a discrepancy between the profit and operating and free cash outflow. One of the main arguments for calling Decadata a high-quality company is just their growth in revenue. So in this particular slide, we're looking at revenue, operating cash flow, profit, and in the green line here is operating margin. So we just focus on the revenue. This company has grown the revenue from $455 million in 2012 to $3.1 billion in 2022. So if you just calculate the compound annual growth in revenue per share over the last 10 years, you get 16.8%. Even the last 5 years and 3 years, consistently above 16%. So the number I'm looking for here is at least above 10% growth in revenue per share. And if we see at least 10%, that's a good sign a company is high quality. Decadata is able to grow their revenue at 15% per year, and that's over a 10-year period. So that's a good sign this company is a high quality company. Now, even though I probably would consider this company a high quality company, you just have to be aware of the margins. So the operating margins for this company typically between about 3 and 4%, or even more typically between about 3.5 and 3.7%. In 2020 and 2021, operating margins went above 4% to 4.25% and 4.37%. Now, you could say maybe this is the start of a trend where operating margins for this company will improve. But the past year, operating margins fell from 4.37% to 3.72%. And that 3.72% is within their normal range. So I don't necessarily think that they will able to grow their operating margins in the next year. And that decrease in operating margins did have an effect on their profit. So even though this company grew their revenue by $700 million, their profit actually fell slightly from $73.6 million to $73 million. Now onto the operating cash flow. So one of the main reasons I did not take a position in this company in 2015 was because they were operating cash flow negative between 2012 and 2015. And in my opinion, that was a red flag to have 4 years without operating cash flow negative. And then in 2016, they became operating cash flow positive. And that's when the market started to take notice of Decadata. And they have typically remained operating cash flow positive from then on until really this year. But that's the main reason I did not take a position in this company, just because they were not operating cash flow positive. And I prefer to see that. So back then, I probably would have not called this company high quality. I would have called this company low quality because we didn't have enough data to really know whether this company was high quality. And back in those days, the market cap of this company was around 200 million. So that you might call that a mistake. But I do have an investing process. And I think if you do have an investing process with rules, you have to follow those rules and very rarely, if at all, break those rules. Now, another sign of a high quality company is when they can grow their dividends through time. And Data is definitely doing that. So this is their dividend history from 2013 to 2023, the most recent dividend. And dividends have consistently grown through this period. Now we get to the most recent dividend, their final dividend of financial year 22, and it was significantly lower than their final dividend for last year. So last year they had a final dividend of 15 cents. Now their final dividend for financial year 22 was 2.5 cents. And that is the main question I had when I started my research on this company. Why was the dividend significantly lower, or their final dividend significantly lower than last year? And fortunately, the company answered this question I had, and this is from their commentary. The final dividend for financial year 22 is in line with the company's policy of paying out 100% net profit after tax. The final dividend is lower than previous financial year, and significantly lower at that, due to higher interim dividends being paid throughout financial year 22, being set at a higher level based on expected higher net profit after tax in the financial year 22 period, due to increased costs incurred by the company in the period, predominantly related to salary and finance costs. The company's unaudited profit result finalized below expectations. So this is all in regards to their interim dividends through the year. They're probably higher than they should have been because their profit was a little bit lower than they expected. So they had 13 cents interim dividends, 3 of them through the year, and 2.5 cent final dividend. So this is not necessarily a bad sign, but when you compare the full dividends in financial year 21, 42 cents, compared to this year, 41.5 cents, there has been a slight drop in dividends, but that's all because of those margin pressures and a slight drop in their profit after tax. Now to the valuation of Data, and this is very important when it comes to high quality companies. So what I want to do is to find high quality companies that are trading at really attractive values. So right now, Data has a P/E ratio of 20.3, which with their growth is not too high. So if I see the P/E ratio of Data get down to say less than 15, this company would become attractive to me in my investing philosophy. Price to sales ratio 0.48. That probably is meaningless for me when it comes to Data. Price to operating cash flow is negative because they were operating cash flow negative in the most recent year. So most of my valuation for this company comes around to the P/E ratio, also to the earnings. So I did do a reverse DCF based off their earnings per share. And this company would have to increase their earnings per share at 11.8% per year to justify the current valuation. And I definitely think this company can do it because this company has grown their revenue at greater than 15% per year. And if they can maintain their margins around 3%, 3.7% per year, definitely I can see this company increasing their earnings at 11.8% per year. And if they can increase their operating margins, there is potential, if they keep on increasing their revenue at 15% per year, their profit will increase, or their earnings will increase at a greater rate than that. So maybe you could argue, particularly if you have a bullish future of this company, that right now Data is trading at good valuations or attractive valuations. Another thing you can do is just compare the current P/E ratio of Data to historical range. Now, P/E ratio of 20 over the past, if you just look at the past, say 3 or 4 years, you could argue that this company is attractively valued because very rarely since the start of 2019 has a P/E ratio of Data been below 20. And right now it's hovering around 20. Only during the COVID-19 financial panic did the P/E ratio of this company fall significantly below 20. And in fact, in 2021, the P/E ratio of Data got as high as 45. But if you go through the period between 2015 and 2019, the P/E ratio for this company was between about 10 and 20. And remember, this company was operating cash flow negative before 2016. So the market was not really willing to pay a premium for this company because of that one red flag. In fact, in 2016, before they released their full year results, when they became operating cash flow positive for the first time, the P ratio for Dicker Data was hovering around 10. And then there was a bit of multiple expansion as the P ratio started to climb, as the market was more and more willing to pay premium for this company because they had hit that inflection point of becoming operating cash flow positive. So from 2015 to 2023, there's been some multiple expansion for this company because the market is more and more willing to pay a premium for this company. So right now, at a P ratio of 20, I think you could argue that this company is attractively valued. Now let's have a look at the chart. And typically for high quality companies, I'm less interested in the chart. I'm way more interested in charts for low quality companies because you do have to ride the sentiment and the trend for those type of companies. And when the sentiment and trend changes, shifts from positive to negative, that's when you drop out and sell your shares. That's not exactly true for high quality companies. But you could say back in 2021, when the P ratio of this company got as high as 45, it was overvalued. Maybe you could have lightened your position. That's one trading philosophy you might have for these high quality companies. But when you look at the long-term chart, and this is the weekly chart for Dicker Data going all the way back to 2012, when the share price of this company was 50 cents. This is the sort of chart you would expect to see for a high quality company, with the share price going from the bottom left to the top right. Now, the share price has been under pressure over the past few years. In fact, the share price has dropped from a high of $16.50 to a current share price of around $8.32. So the share price has more than halved, or about halved, during that period. And one of the reasons it's halved was because the valuation of this company was a little bit too stretched in 2021. That does not mean, just because the share price has halved or nearly halved, does not mean this is a low quality company. It's just the valuation is coming more into line with what you should see for this type of company. But there is one interesting thing when you do look at the shorter term chart. So let's have a look at the shorter term chart and just where the share price is heading right now. And the share price has fallen through a fairly significant level. And that significant level is a support level. Well, it was a support level at around about $8.90. And that was the lows we saw back in May 2021, before we saw the share price go on a nice run from $8.90 all the way to that high of $16.60. It didn't take very long for the share price to get from that low to that high. In fact, it went from that low to that high in about a 4 to 5 month time frame. But definitely the share price of Dicker Data right now is in a down trend. The share price keeps falling. This is a classic downtrend. It has fallen through that support level. So that support level has now become resistance. But more than likely, as the share price keeps on falling, there's going to be value traders, investors out there who will see some value in this company. Definitely, if the share price keeps on falling, more and more those value investors will see opportunity to take a position in this company at good value. So I would expect more interest in this company as the share price keeps on falling. And I am becoming more interested in this company because the share price keeps on falling. I plan on doing this Kneppy's analysis series for a while yet, maybe forever, who knows. And the next 5 companies I'll be featuring in this series include Supply Network, a surprising high quality company. I did a little bit of research on that company and it came back as a high quality company. Mineral Resources, Index, Macquarie Bank, sort of a flip side to Supply Network. I expected a really high quality company, and I actually am questioning whether I could classify Macquarie Bank as a high quality company, and Sonic Healthcare. If you do have a suggestion of a company you like me to feature in this series, just leave that suggestion in the comment section of this video. Preferably, I like to do videos on companies that are profitable, growing their revenue, not necessarily growing their revenue, but profitable, have at least some sort of revenue, and definitely not concept or story stocks. So leave your suggestion in the comment section of this video. That's all I have for this video, looking at Dicker Data. If you do have any questions about this company, or maybe you disagree with me in regards to the quality state of this company, if you think Dicker Data is a low quality company, I'd love to hear your opinion. So leave your opinion, your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.